Good morning, everybody. Welcome to our first Mindset Meets Mechanics webinar. So we'll be running a series of these over the coming months and well into the New Year's and beyond. So this is the first one, Mindset Meets Mechanics, and the objective for today is to give you something to think about in terms of the structuring of your portfolios through different stages of the investing lifespan. So I'm going to try and provide a little bit of context about where you might be as an investor in terms of your investing lifespan. And so we'll actually sort of break that down and quantify that a little bit and discuss the various stages that we all go through as investors and some of the risks and opportunities in those stages, and discuss a little bit about some relevant strategies as we progress. So that'll provide a little bit of context for us, and then we'll break that down further and start thinking about portfolio considerations at each of those particular stages, and then how you might structure a portfolio when you first start using SPA3 Investor. So some of you who are very new will certainly find this information very relevant. Those of you who've been around for a little while, there might be some new takeaways for you as well, perhaps that you haven't considered before. So welcome to this webinar. I look forward to joining you on many more. All right, so let's get underway. So this is what we're going to be discussing today. So our agenda. And we'll be having a look at some critical investing concepts. Now, those of you who've been with us for a while may have already read the critical concepts white paper that Gary and I wrote a number of years ago, outlining a number of the really important issues with our investing. So the two biggest investing risks, what are they and why are they so important? And also discussing the various, the various investing stages. It also goes through and discusses, some of the hurdles, some of the challenges with our investing that we need to be mindful of. And obviously, the earlier we can become aware of some of the challenges, then it gives us time to do something about it. We'll then branch out and have a look at core and satellite portfolios, what they actually are, looking through the basic concepts. We'll look through some examples of those. And then importantly, a question we often get asked is, David, if I'm transitioning to the SPA3 investor methodology, what's the best way to go about it? What do I do with my existing portfolio? Should I move all that across and start a brand new portfolio, one big one, or should I just deal with small amounts of capital? What's the best way to do it? So we'll go through and break that down. And then we'll have a summary and Q&A at the end. So just before we start, I just need to make sure and run this past everybody that the content of today's session is purely educational in nature. It doesn't take into account your individual circumstances or needs, and so therefore is very much general. All right, so let's get into things. So the critical investing concept. So this, as mentioned, is a white paper that Gary and I wrote a number of years ago, and I'd really like it if you could all take the opportunity to download that and have a bit of a read through it. And a number of reasons for that, because if you have any young children, adults, etc., then becoming aware of some of these issues will definitely help their investing journey, in their many years ahead. So some really important concepts that I think are worth discussing and bringing to the attention of any younger folks out there who are at the stage where they're starting a new career, a new job for the first time, and really setting the groundwork early on for later investing success. So this critical concepts white paper, it is housed in the ongoing training and resources centre of the education centre. So there's three main steps. You have the 4-week intensive, which is step 1. Step 2 is all about the process, and step 3 is ongoing training and resources. So this is where we house all the recorded webinars, etc., and obviously the weekly wrap. And this particular Mindset Meets Mechanics webinar will be housed as well. It'll be under the recording section that you can see there. But under this other section, critical concepts, you'll find that's where the white paper is, and all you need to do is click on the link and you'll be able to download that. So that's a heads up, that's where it is, and that's something that you can read a little bit later on. So what does this white paper contain? So two of the biggest risks that we face as investors are covered in the paper. And the first one is not growing your capital sufficiently to provide for an adequate retirement. So this is the biggest risk that you're going to face with your investing. So it's really important that we understand how to set the groundwork to do that, to set ourselves up so that when we're into our 50s, 60s, 70s, we don't need to worry about where our funds are going to come from in our retirement. So that's the biggest risk that we're going to face. So that's covered in there. The second biggest risk, what is it? Well, it's being fully exposed to a bear market just prior to retirement. So the first risk, growing that capital sufficiently, so it's critical mass so that we've got plenty there for when we retire. But importantly, we don't want to then subject that to the second biggest risk, which is being fully exposed to bear markets just prior to retirement. So if you think big bear markets and the impact that they can have on your retirement, planning for retirement, when you're actually going to take retirement, you've only got to think back to events like the GFC. Even COVID, we didn't know how long COVID was going to last. So for people who were thinking about retiring at the end of 2019, beginning in 2020, that would have been a pretty scary time. Fortunately, the market happened to bounce back fairly quickly from there. We've got lots of other examples as well. We've got the dot-com crash of 2000. So if you had a lot of money in internet-based stocks, etc., then you would have been having to hang on to those for a long, long time, waiting for them to come back if you didn't have any particular system that you were following. Other examples, 1987, one that, a number of you might still remember. Some of you might be a little bit younger than that, but we've got to be mindful of big bear markets and when they occur in our investing lifespan. And that is basically called sequence of returns risk. So important concepts. So throughout the white paper, we use as the background, if you like, the 3 stages. So we identify 3 stages and then define that stage 1 being from 18, or your first job, if you like, through to around about 55 years. Now, why 55 years? Well, it's, in a nutshell, it's around about 10 years before retirement age. So it's a very, very long stage, and there's lots of really good things that we can do during stage 1. And so that is setting up yourselves for, a successful retirement. That seems a long, long way away for anyone who's 18 or 20, but there's some really simple things you can do to get that ball rolling and that snowball really moving, particularly as you get further and further into stage 1. Stage 2 starts at 55 and goes to 65. So really it's that pre-retirement window that we're looking at. And this is where most of our members are situated in their investing lifespan. So they've accumulated funds through stage 1. They're getting towards retirement. They can see it on the horizon. They're starting to worry about sequence of returns risk, those big bear markets, and what might happen to their capital if they're fully exposed during those market events. And then the final stage is stage 3, and that begins the retirement. And that's actually the second longest stage. Okay, so that might go from 65 all the way through to 90 as an example. So retirement's just a date. We don't stop investing just because we've stopped working. We've got to make sure that our capital is growing to provide for potentially 25, 30 years of income into the future. So we just put that in cash, then what's going to happen? We're going to have events like inflation risk eating away at that capital. Okay, so we've just got to be clever about the way that we structure our investments, our strategies, to make sure that we don't get battered around by sequence of returns events. Right, so the biggest problem faced during stage 1 is not achieving high enough investment rates of returns on your savings or your investments. So this is the biggest financial risk that everybody faces over an investing lifespan. So in stage 1, what are some very simple things that we can do? So if you don't happen to have much time, and I've got younger adult children, and this is not financial advice, but I think it's something that makes a lot of sense, is because they've got a superannuation guarantee that each month their employer has to put funds aside for them into their super fund. I've simply asked my 2 adult children, I said, look, it's not a bad idea if you can match the employer contributions. Now, particularly they're both my wife and my children, they're girls. And I think this is really important for females in particular, because oftentimes they will spend time out of the workforce if they're starting a family, for example. And sometimes because of that, they tend to be a little bit behind the 8 ball in terms of where their partners may be in terms of their superannuation. So getting them to match the employer contributions is something that if they do it from very, very early on, they get used to it and they no longer need to think about it. It's one of those things that just keeps on happening. They don't need to think about it. They don't have to budget to put money in. It gets taken out automatically. So obviously from that point of view, the other sort of thing is that they may well be in a super fund early on. And I've suggested to them, look, being in high growth makes sense. They've got a long period of time. They don't need to worry about sequence of returns risks because they've got many, many, many years ahead of them. And one of the little known facts is that when we go through large bear markets, on average, it takes 6 to 7 years for the markets to come back to those previous levels. So that's why if you're about to retire and you go through a big drawdown, like a GFC type of drawdown, you may be needing to wait 6 or 7 years for your funds to return back to what they were. Now, if you need to live off those funds, that's going to be a big issue. So in stage 1, those sequence of returns risk, the actual risk is very low. It will still, potentially can still happen, but the impact of it is not going to be nearly as severe. If it does happen to happen, well, then they get the extra benefits of compounding along the way and dollar cost averaging, reinvesting those dividends. That's a very simple way to do it if they're using, as an example, an index. So an index, long-term buy and hold of an ETF is a very simple way that they can also do it if they want to take an active interest outside of their superannuation funds. That's something that they could also do as well. And that's a really simple, easy way to go about it. So it's a longer stage. The benefits of compounding are huge. And if they don't have a lot of time available, then just getting them to add to their superannuation contributions, I think, is a really good thing to do. So that's stage 1. Now, if you did happen to have a little bit more time and you were interested in following the stock market and learning about stocks, then you could establish your own portfolios of not just an index ETF. You actually start purchasing some stocks and using that as a buy and hold, or even learning a little bit about different methods of investing. So there's lots of opportunity in stage 1. However, it does become riskier towards the end of stage 1. So stage 1, think about it, you're getting up towards 55. If you're using a buy and hold type of approach, what are the risks with that? By now, if you've overcome that big problem of having sufficient capital, and if you're doing this all the way from early days through to mid-50s, you're going to have a fairly sizable chunk of capital. So you really need to start thinking about the risks as you're getting towards that pre-retirement and retirement window. Okay, and those large bear markets. Stage 2. Okay, so sequence of returns risk is the second biggest risk that investors will face. So this is stage 2. So we're looking at that pre-retirement window. So to lessen the impact of those severe market events, a simple in and out 100% mechanical buy and sell system can now be introduced. So in our case, we're looking at SPA3 Investor is one of those simple mechanical systems. Now, at this point in time, you can decide to how much you want to protect as part of a portfolio using that methodology. So you can start to decide whether you want to start off with a little amount, which I think always makes sense, and then perhaps over a period of time as your skills develop, start thinking about adding a little bit more. So this is the shortest stage, stage 2. And so it's a period of time where a lot of people come to us finding out a little bit more about, they might have a bit of trading experience as an example. They might have an interest in the markets. They're starting to think about their retirements and more so protecting their capital, that big, overcoming that first challenge, building that big chunk of capital or as much as possible, and then starting to think about protecting it. So it's a short stage, and this is really a key skills acquisition stage, if you like, prior to experiencing those large market drawdown events. Okay, so it's the shortest stage. You can certainly use ETFs or stocks. So we're thinking about the financial markets in this particular context. However, if you're going to start using a mechanical system, then guess what? You're going to need a higher level of mindset skills. If you think about the mindset skills for a buy and hold portfolio, do you need any particular skills? No, you don't. But if you continue to follow that methodology all the way into retirement, and we happen to be exposed to GFC type events, then at some point you're going to start feeling a degree of pain. Okay, and that just comes through not having a system that's going to protect that downside. So you just need to think a little bit about that and how much effort that may require. Stage 3, well, that's the happy stage. So hopefully by now in retirement you've accumulated sufficient capital, and this is the second longest stage. So again, it could well be 30 plus years depending on your health, and hopefully your health is A1. The health is the most important thing in your life. So hopefully you've got good health at this particular time. You've got plenty of funds. So you've got a long time ahead to have a relaxed and happy retirement. So what does it mean in retirement? So because you're still going to need income, and you're going to need to make sure that your investing capital is still retaining its worth, then growth still needs to be one of your objectives. So then that can also include income. Why? Well, longevity risk. What happens if you outlive the funds that you've accumulated? You need to be thinking about that. You need to be thinking about how much capital do you need actually in your retirement so that you can go on 2 or 3 overseas trips a year as opposed to one every 5 years. The inflation risk. We all know that in the last few years, what's happened with inflation. If you've only got to cast your mind back 4 or 5 years ago, and inflation was very, very low. What's happened since? The cost of living, etc. Government pensions, can you rely upon those as well? So it's just some things that you need to be thinking about along the way. So particularly in stage 3, a more conservative approach that focuses on preserving and protecting capital. So again, how do we do that? How do we know when to have our capital invested? How do we know when to have it perhaps sitting on the sidelines seeking shelter? So what we're doing there is we're just providing a little bit of context in terms of the stages that you're going to be going through in your investing lifespan. Okay. So now what we're going to do is just discuss this concept of core and satellite portfolios. So those of you that are familiar with any form of astronomy would be familiar with the idea of, the Earth, as an example, being a planet, and surrounding the Earth, in this case, we've got a moon. You might have a look at an example like Neptune, which has quite a number of moons. So another name for those moons is satellites. So how can we apply this particular idea, if you like, to our investing? So the way we can think about it is that the planet, that large body, is a core. It's what we would refer to as a core portfolio. So a core portfolio is one that will contain at least 50% of your total investing capital. Okay, and it tends to follow a fairly passive type of strategy. And we'll go through some examples in a moment. The satellite portfolios are smaller portfolios that are, if you like, linked to the core portfolio. And the smaller portfolios are going to contain less than 50% of the total investing capital. So why do we have these smaller portfolios? Well, effectively, the reason for doing it is that we're seeking higher returns. And we're being sensible about this in that we're looking for higher returns, but we're doing it with a smaller amount of capital. Because if you were to use a portfolio the same size as your core portfolio and you're seeking higher returns, you need to remember that often seeking higher returns is also associated with higher risk. So you want to make sure that your satellite portfolios aren't so large that the risk on them, if everything goes pear-shaped, upsets the complete apple cart. So that is the total balance of all your portfolios. So that's why you want to start off with, when you have running satellite portfolios, riskier, higher return strategies, that you need to make sure that they're not too big. Now, when we think about this, if you think about a core portfolio, you might think that a core portfolio, because it's passive and bigger and it doesn't really, it's not after as much growth, might be safer than a satellite active portfolio. However, you need to think about what those funds are invested in and what the risks are. So remembering a core portfolio during stage 1 and into stage 2 is not going to be facing a lot of sequence of returns risks. But as we get closer and closer to stage 3, retirement, and just prior to retirement, that passive type of buy and hold strategy is going to be more and more exposed to that sequence of returns threat. Okay, so we don't want to be thinking that just because I've got a core portfolio that there's no risk attached to it. So hopefully this is making sense. So as an example, a core portfolio, and I've just plucked out a few different assets that might be in a core portfolio just to illustrate the point. It's the bulk of your investing capital, and it uses largely a passive type of strategy. So a buy and hold type of method. And that might contain residential property investment, for example. It might contain commercial property. You might have some artworks or some collectibles. You know, it might be some old cars. It might be jewelry. It could be, you know, artwork, etc., that you've got as part of your investing portfolio. You might have some capital invested in some bonds. You might have some hard metals like gold and silver, as an example. You might have some long-term investments in Bitcoin, as an example, not knowing what's going to happen with with cash, etc. You might have, over a period of time, developed a share portfolio or an ETF portfolio. Now, ETFs haven't been around forever and ever and ever, but they're certainly growing in popularity because they offer a diversified portfolio without as much individual stock-specific risk that we can sometimes be exposed to. And again, you've only got to think back to the GFC when, even blue chips disappeared from the face of the exchange. So you've got to be, a little bit careful about that. But again, this is a core portfolio, largely passive. And, I know a lot of people who've done really well out of a buy and hold strategy with shares over a long term. However, with that, you'll also find out that there'll be a number of shares that they've had but buy and hold that they've bought and held all the way to zero. On the other side, they've had some that have gone up and made up for those that have gone to zero. So interesting stories there. And if they wish they had their time again, what would they have done differently? Well, they would have had an exit strategy for those ones. So they didn't have to see their individual stocks go to zero. Sequence of returns risk potentially having an impact at that particular point in time. You might also have some capital in cash or fixed interest, as an example. So this is just one idea of what a core portfolio might look like. So the benefit of this, particularly in stage 1 and 2, is that you get the benefits of compounding. So, that largely passive type of buy and hold through stage 1 and 2. However, in stage 3, as the asterisk says, we need to be mindful of sequence of returns risk. All right, so in this particular example, we've got a core portfolio and roughly 15% of it is invested in the stock market. So that'd be about $150,000. Another example might be that you've accumulated some wealth through residential property investment and shares. So it's just a 50-50 split. You might not have some of those asset classes. So again, it's a portfolio assuming around about $1 million. It's the bulk of your investing capital. Again, buy and hold type of strategies. Okay, most people, when they do residential property investment, they buy and hold. Does property always go up? Well, over the longer term, it tends to. Does the share market always go up? Over the long term, it tends to. One of those is a little bit more liquid than the others. One of them you have to put up with tenants, one you don't. There's advantages and disadvantages to both. So they're both long-term buy and hold types of strategies in this particular example. And again, great for stages 1 and 2. Stage 3, we just need to be mindful of that sequence of returns risk. So in this particular example, we'd have 50% invested in the stock market and the other 50% in real estate. Alternatively, you might just have one large share or ETF portfolio that you've been accumulating all through stage 1. You know, this might well be outside of your superannuation. As an example, it might be an inheritance. It could be something that you've just out of interest accumulated over a long period of time. So this is, if you like, this is a little bit of like a Warren Buffett type of strategy. Buy and hold compounding works really, really well in stage 1. So in this case, a whole lot of capital in that core portfolio. It's the Warren Buffett method. So he just recommends grabbing your capital, investing in it in an index fund. He suggests, SPY, the S&P 500 index, and just reinvest the dividends. And that works really, really well, particularly in stages 1 and 2. However, in stage 3, you've just got to be mindful of sequence of returns risk. Okay, so that's very important, and it's always going to be there. It's just going to have a different impact in different parts of your investing lifespan. Right, so let's move on to a satellite portfolio. So satellite portfolios are obviously less than 50% of your capital, and they typically are much more active. And they're active because they are seeking higher returns. So they're looking to make the most of the rises in the market and not participate in the falls. So if you can participate in the rises and not the falls, then over the longer term, each of those steps up gives you a greater return than a buy and hold. Okay, so that's one of the reasons why you look to do that. So this starts to work and become much more favourable in stages 2 and 3, because when we're using, as an example, SPA3 Investor, what we're looking to do is to start using some timing to generate those higher returns. Now, could you do it in stage 1? Absolutely, you could. It's just that it may require a little bit more time than what you might have available when you think about what your life is involved with in those years from 18 through to 55. A lot of time commitments, time pressures that you'll have upon you with career, family, and so on and so forth. So in this particular example, if we had a total satellite of funds available, $150,000, then in this particular example, using that as a satellite portfolio. So if you might think back to our first example, we had a core portfolio where we had $1 million, and a small wedge of that, around about 15%, was allocated to the stock market. So from that point of view, of that total portfolio, you're using only about 1/7, if you like, that you're allocating to an active type of strategy. So we're just breaking that down as an example. So if you had $150,000, how might you split this? Well, you could certainly split it between 2 different portfolios. You might have one for an ASX shares portfolio. You might have one for a US shares portfolio. Again, where does this make most sense? Well, if you've got the time, you could do it during stage 1, but really importantly in stage 2 and 3, because we're still being mindful of that sequence returns risk. That's the second biggest risk. So just give you a little bit of context about how you can do it. Now, the other advantage of running 2 satellite portfolios is that it gives you the opportunity for exposure to other markets. Not all markets march to the same beat of the drum. Okay, it would be nice if they always did, but the fact that they don't gives us the opportunity, and it also spreads our risk at the same time. So 2 $75,000 satellites is how you could use those particular funds. So it's a smaller chunk compared to your overall core portfolios. So what are some other examples of satellite portfolios? So again, using that 150,000 stock market allocation of capital, we could split it into 4 portfolios if we wanted to. We could do it with ASX shares, US shares. You could also use an even more active strategy for, as an example, SPA3 trader. You could do that on the ASX. You could also do it on the NASDAQ. You might have another portfolio of that you're using your own strategy or some other strategy. The important concept here is that each one of these portfolios is looking to achieve higher growth, but at the same time is also potentially taking on higher risk. Now, if you think about it, is that risk higher than what a core portfolio with a passive strategy might be exposed to? So you need to think about that. Does being active necessarily mean higher risk compared what might happen to a buy and hold strategy during a large bear market, compared to where you're using a strategy where you're using some timing to help protect the downside? You need to be thinking about that. Okay, so 100% is in the financial markets, and we've got 4 different satellite portfolios, and quite a number of experienced members have 4, 5 satellite portfolios, and some of them may even run leverage portfolios on top of that as well. So their skill set, if you think about it, is highly developed, and they're learning those skills on smaller portfolios, and I think that makes a lot of sense. So let's just imagine for a moment that your core portfolio that you've got is a share and ETF portfolio, and you've come to Sharewell Systems because you want to learn about timing the market and protection, avoiding risk number 2, and that is being exposed to those large bear markets. You've got a large, substantial portfolio already. How might you start? What could it look like? What makes sense given that you're new to this style of investing and you've largely done buy and hold before? It's worked well in stage 1. You're into stage 2. You've accumulated a large amount of capital, but you've experienced COVID. You remember the GFC. You vaguely remember your parents telling you about 1987 and your great-grandparents telling you about 1932, 29 to 32, and you're interested in protecting that capital while still being exposed and also seeking growth. So $500,000, how might you allocate the capital? Well, I think it makes sense to start off small. So using that $500,000, continue what you're doing, but take a portion of that. Now, a portion of that, for you, you're only going to know whether it's too big a portion or too small a portion after you actually start. We can't recommend how much you start with. That's going to be a personal decision depending on your own risk profile. But I think it makes sense to start small and then improve your skills as you proceed, because as your skills become better and better, your mindset is growing, then you're going to find that you're going to be able to increase the size of those satellite portfolios. So allocating 100K and then perhaps splitting that between 2 portfolios, one with the Australian market in mind and one with the US market in mind, to me, is a simple way to approach it, to get started, build that skill set. Why have the 2 markets? Well, we don't know which market's going to move. And there's plenty of examples where the Australian market has massively outperformed the US market, and there's lots of examples vice versa. So having a foot in each camp, I think, really makes sense. Then after a period of time, once you've really got into the mindset aspect of it, because when you think about it, using a timing strategy like SPA3 Investor is not difficult. You've got a green arrow to get in on and a red arrow to get out of. Okay, it's our mindset that sometimes makes it difficult. So after a period of 2 years and you've done multiple lots of 25 trades, which is what we suggest to all members, and even after 2 years, to continue doing the 25 trades, making sure that you're plotting your path along the way. There's always something to learn. So after a period of 2 years, your mindset skills have improved to the point where now perhaps you can take a little bit more of that capital from the core. So taking $200,000 or increasing the amount that you have exposed as satellites to 200 in total. So that is increasing the capital to $100,000 in each portfolio. So again, that's going to have a slightly different feel to it. It's going to sharpen again your mindset, because all of a sudden your position sizes are twice the size what they were to begin with. So once again, continuing on, and after a period of a number of years, it might be another 2 years later on, you could actually start to increase the size of those satellites. And now what you'll notice here is that that original core portfolio is actually reducing in size. Remember, that core portfolio is still using that buy and hold strategy. Now, if we think about our timeline, we're in stage 2, potentially into stage 3. And so when we're in stage 3 in retirement, we don't want to have all our capital exposed to the large bear markets. However, there's still some value in having a small amount of buy and hold, particularly if it's an index, okay? Because an index has what we call survivorship bias, okay? So indices aren't ever going to go to zero, whereas stocks can. Indices are rigged, if you like, because they contain only the best performing stocks. Any stocks that their performance starts to deteriorate. Now, in terms of performance, I'm talking about the amount of capital and profits that these companies generate. If they start to fall in capitalization because they're facing more competition, they're becoming unprofitable, maybe the management has mucked things up, then their capitalization becomes smaller and smaller and smaller. And guess what? They fall out of the S&P 500, as an example, and they'll go into the S&P 400, the mid caps. And if they continue to deteriorate, they'll go into the small caps. And then eventually, if they fall out of small caps, then they may in fact be delisted. That can happen. On the flip side of that, those companies that are doing really well, that are mid caps, can then become large caps. And so what's happening there is that we've got this survivorship bias built into individual into index ETFs. But unfortunately, stocks don't have individual survivorship bias. Okay, so just something to think about there. So as your skill sets improve, you've got larger and larger active portfolios. Okay, and that's what some of our members choose to do, because they've acquired the various skill set to be able to do that. All right, so why start SPA3 Investor as a satellite? Well, it reduces risk while learning the skills. So what are the skills? They are largely mindset skills, okay? So making sure that you're able to trade through a range of market conditions so that you're able to trade through market drawdown. And this is one of the ideas, the major objectives of a skills acquisition plan is to get you to be able to trade through multiple 10 to 15% periods of drawdown. Now, if you can do that with smaller satellite portfolios, then as your skills develop greater and greater, then you can do it with more and more capital. Okay, so that's one of the advantages to it. It reduces the anxiety. So when you're starting, you're not doing it with your total core portfolio. Okay, you're not putting so much stress and anxiety onto the process. You can imagine what it's like. I often use the analogy of learning to drive a car. You've just got your license. You're familiar with the process. And then all of a sudden, you get asked to take, I don't know, let's use the example, the king for a ride in the car. Imagine the anxiety you might be presented with if that was the case, or you had to take your entire family. Let's make it a local example, and you had to drive them, to the football or whatever it may be. So, overloading yourself with risk is just a recipe, and particularly anxiety when your skill set isn't ready. It's a recipe for disaster. Okay, so you want to make sure that you're starting off small to give yourself the time to develop the skills. Okay, remembering again, in the car example, as soon as you get your license, does that mean you're a great driver? No, it doesn't. You're going to have to go through lots of different changes in weather conditions. You're going to have to put up with flat tires. You're going to have a few bumps and dings on the car, etc. It's not, the driving conditions aren't always going to be the same. Okay, and you're always going to have the chance that somebody is going to come in from the left and go straight through a red light, as an example, and cause a major accident. So that, if you like, that's obviously a major risk. A sequence of returns risk. When does a bad accident happen in your driving career? Okay, you need to be thinking about these sorts of things. Now, I know it's just a metaphor, an analogy, but hopefully it makes sense. It's going to give you the time to boost your confidence as well. So starting small, getting into the process, understanding the role that your mindset plays is just so important. Dealing with drawdown, so becoming skilled, I just touched on that one before, and also exposure to multiple market opportunities. So the ASX over the last few years has been a really difficult market to trade. Okay, we use a trend following system, and the Australian market really hasn't trended that well. But on the other hand, the US has. There's been lots of opportunities to get extra growth through that particular market, whilst the ASX has had very little growth. So being exposed there, by doing that, it also cuts your risk by 50% by being diversified, but it exposes you to those other opportunities. And the other aspect of this, obviously, as we're in stage 2, working towards stage 3, you might already be in stage 3, is preparation for a sequence of returns risk events. So this is what it looks like. Again, just to recap a little bit, the core portfolio, it's a portfolio that holds the bulk of your capital. It's a low skills requirement and tends to use a buy and hold type of strategy. Now, that's best suited to stages 1 and 2. Satellite portfolios, smaller amounts of capital that do require a higher skill set. So why do we have the 4-week intensive? That's really there primed to get those skills starting to grow. It does require work. So the commitment there is the 25 trades exercise and the constant repetition of that, learning the 5 fundamental truths, etc. Adopting that sort of approach, and you can use it with either a stocks or an ETF timing approach. Now, the benefit of doing this is over a period of time that you can gradually take capital from your core and expose it to that more active strategy. And the benefit of that is that it's helping to reduce that sequence of returns risk by using an entry and exit methodology. So they're the key reasons why, we use that type of methodology, particularly in stage 2 and stage 3. So a quick summary of some of the things that we've covered today. The 2 biggest risks: not growing capital sufficiently in stage 1 and stage 2. So I've touched on some ideas that you could think about, particularly if you've got younger folk in your family. What a difference that might actually make by the time they get to their 50s and 60s a bit further down the track. They'll be thanking you for that. So the second biggest risk, being exposed to large bear markets near or in retirement, so stage 2 and stage 3. So how do we avoid that? Well, using a timing-based strategy like SPA3 Investor. It helps to maintain exposure for growth, remembering in stage 2 and 3, particularly in stage 3, in retirement, you need to make sure that your capital is still growing, okay? Otherwise, there's a risk you outlive your capital. So if your health's really good, but you don't have sufficient funds there for a comfortable retirement, then you might find that your retirement's a little bit miserable. You don't want that. So we need to maintain, especially to get growth, but we've also got to be mindful of that sequence of returns risk. So reducing exposure to those large bear markets. So how else can we do that? Well, through the use of core and satellite portfolio models. You can maintain your existing passive portfolios, establish smaller satellite portfolios, so more active satellite portfolios, work on developing your mindset skills, and then over a period of time, those satellite portfolios can take on a larger and larger amount of capital, and so therefore overcoming that big problem of being exposed to large bear markets. Remembering that most of our members are in stage 2 and stage 3. If you're in stage 1 and you're still growing capital, etc., then certainly you can use a variety of strategies, whether it's buy and hold ETFs or buy and hold stocks, or timing of ETFs and stocks. The benefit of doing that in stage 1 is that you've got such a long time to develop those mindset skills, and you're doing it on a smaller amount of capital relative to, say, stage 2 and 3, that the risk of doing it with too much capital and overdoing things and putting too much stress on yourself, that can be lower at that point in time as well. But it does require a little bit of effort, and depending on how busy your lifestyle is at that time. And as mentioned, over a period of time, you can transition more funds into active satellite portfolios over time. So we've got a wrap up there of what we've discussed today. So just trying to provide a little bit of context in terms of the investing lifespan, the different stages, the different risks, some of the strategies that you can use in each of those stages, and then thinking about how we might use a core satellite portfolio model to allocate our capital. So hopefully that's helped to provide a little bit broader context. So some questions, if anyone's got any questions, as an example. So Bruce says, start with one satellite to practice the process. Yeah, absolutely, you can. You could do it with one market, and a number of members do that, Bruce. So some will start with the market that they know, the ASX, as an example, and then they might say, look, David, I've been doing this for a little while. I do notice that you run public portfolios in other markets, and again, that's a key reason for doing that, to show, what happens when you follow exactly the same process in a different market. What are the results over the longer term? And one of the things we'll discuss in future sessions that we run is a comparative between markets, between the Australian and the US, and different portfolios. So yeah, absolutely, you can do that. You can do it with one market to start with. If you've got sufficient funds, you might like to spread it between the two, or you might just say, well, look, I'll just do it with the one market to start with and see how I go. And then at that point, if you wanted to, you could split that satellite into two, or if you're feeling confident, you might add a little bit more capital from a core, again, if you've got some funds available, and establish that second satellite. So really and ultimately, your ability to trade multiple satellite portfolios will be a function of your mindset. So if you can't yet do it in one satellite portfolio, then you're going to find it difficult trying to do it with two. Likewise, if you start a satellite portfolio with too much capital, then you're going to find it really difficult to do. And I'll tell the story of a gentleman a number of years ago who came to us and was all very excited, established a new portfolio. He started off with $50,000. Now, he actually had $500,000 available. So he did the right thing. He started with a satellite portfolio, and he started in November, and we had a little bit like a Christmas rally, and his portfolio at the time in the last 2 or 3 months of the year went up about 10%. And he thought, fantastic, this is brilliant. So imagine the 25 trades exercise. He's probably at this stage done about 8 trades, and his portfolio's up. So at that point in time, he thought logically, great, if I can get this return on 50,000, imagine what it would be like on 500,000. So at the beginning of the year, he put in the other 450,000. The market went through a bumpy patch, which it often does in January. And he started to experience drawdown. Not drawdown on a $50,000 portfolio, a portfolio 10 times larger. So he started to get drawdown. None of the trades that he were in were anywhere near the protective stops. But what did he do? He threw the rule book out. He panicked. He was second-guessing things. Think about his mindset, his skill set. Was it developed or not? Was he able to recite the 5 fundamental truths? Was he able to really internalize what it means to completely accept the risk? You think about that, what he was going through there, and all of a sudden he started cutting out of trades. There weren't any exit signals. He was cutting out. The market would bounce and he would jump back in. There were no entry signals. He was all over the place. Okay, so that's just an example of the wrong way to start. He got the first little part right, established a satellite portfolio. However, he didn't give himself time to acquire the right skills. And certainly a jump from $50,000 to $500,000 is way too big a jump. Okay, so he really put the cart before the horse and did it the wrong way around. Okay, so we need to be mindful of that. And that's why the 25 trades exercise is such a good exercise to do, to capture some of those thoughts. So thanks for that. Thanks for that, Bruce. Vernon says, thanks, David. Ron says, has a comparison been between trading the NASDAQ using SPA3 investor with leverage and SPA3 trader been done? Good question. I don't think so at this point, but that's one that we can have a look at. We can have a look at the comparison, because Gary runs a leveraged investor portfolio in the US, and we could go through and have a bit of a look at the NASDAQ portfolios, because we run a NASDAQ trader portfolio, and have a look at some comparisons there. So good idea. So it's good to be able to look at different portfolios and think about what's the mechanics, what's the process behind this, the level of activity, the level of mindset that's required to execute these particular portfolios. Because it's very simple to look at an equity curve as an example and see the peaks and troughs and say, yeah, I could trade that. But it's not until you actually get into it and have a look at the individual drawdown periods, the depth of the drawdown in terms of percentage, but also the time in drawdown and what impact that might have on your mindset. So if you've got a really well-trained mindset and you're completely at peace and completely accepting of the risks, then you're going to find it a lot easier to trade through those periods of drawdown compared to somebody who is unskilled and panics at those first times that you go through drawdown. And you're going to go through drawdown. You simply cannot avoid it. Okay, but it's a skill to be able to trade through drawdown, and our most successful members have all got that skill. Okay, and that's something that we, ideally we'd want all of our members to be able to develop. And so you will be able to develop if you structure things appropriately to give yourself the best chance of developing those skills. Okay, so starting small and then building. All right, guys, I think that might be it. Oh, no, a couple of other questions. From Wayne, David, is this strategy valid for avoiding inflation risk in retirement stage 3? So the only way really to avoid inflation is to keep ahead of inflation. Okay, if you put your money in the bank, it's going to earn a fixed rate of return. You're going to be taxed on that as well. And so you just need to be a little bit mindful that if you're getting 4% in the bank and yet inflation is at 6%, then the value of your capital is actually deteriorating. So we want to try and keep ahead of that. So you need to do that through growth assets. Okay, now obviously we use the stock market because it's highly liquid. Okay, if you've got funds in an investment property, it's a little bit more difficult to try and sell parts of your property. You need to go through trying to redraw and those sorts of things. So In terms of keeping ahead of inflation, growth assets, so we therefore stocks or ETFs to get the growth. So as the markets are rising, and trying to reduce that downside risk, so that through the use of timing. So are you going to consistently get a year-by-year fixed rate of return in the market? No, you're not. You're going to have some years where growth might be under inflation. You might have years where it's 5 times inflation, as an example. And so that's what you're looking to do. Importantly, in stage 3, the focus really needs to be on, look, you just want to make sure that your capital doesn't go backwards by too much. Okay, that's the biggest risk. Okay, so how you choose to do that, timing means your capital is sitting on the sidelines. Okay, so it's protected from that point of view. So hopefully that helps a little bit there. Wayne, Kevin says, what length of time should I see how I'm going in satellite portfolios? Yeah, so it's a good question. I like to use the saying, look at the calendar, not your watch. So the idea of the 25 trades, if you like, is to try and give you some breadth of context in terms of time, and monitor your skills versus the length of time. So the 25 trades exercise will take most members around about 12 months, give or take, depending on what's happening in the market. And so that's probably the first step to say, okay, how have I gone during these first 25 trades? Because you might find that, you just happen to be lucky when you start and the market goes up for the first 12 months. Okay. Or you might be unlucky and find that the market goes down for the first 12 months that you've started. Okay. So if you think about those two and the skills acquisition plan, in which two of those scenarios are you going to be learning the most? So don't always think about monitoring in terms of equity curve, okay, or gains, because really you're going to learn much more and develop as an investor and a trader when you go through drawdown. And the more times you go through drawdown and are able to trade through it, the greater your skill set. Okay, so you're going to become a very resilient, robust trader that can trade peacefully, calmly through all market conditions. Okay, so that's one of the things. I know it's been difficult for a number of members in the Australian market over the last few years because the market really hasn't trended very well at all. So what does that mean? It often represents itself as drawdown in our portfolios. That's a big challenge. But if you can work your way through that, through learning new skills, the 4-week intensive is deliberately aimed at that, and you can trade through those periods, then you will become a well-honed, well-skilled trader that will be able to trade mechanically without fear, without noise for the rest of your life. And that's the reward for doing it. So hopefully that makes sense, but it's a good question. All right, well, I thank everybody for coming along today. I think that might be it. Bruce just saying, great start to the new webinar series. Thanks, Bruce. All right, well, the next one there, as mentioned, is on the skills acquisition plan. So I'll take everyone through how to, first of all, to read the skills acquisition plan, why we've got it, and how to create your own so that it's suiting your particular needs, and why we actually need the skills acquisition plan. So that'll be the next one. That'll be in around about a month's time. So in between now and then, we'll do another what's up with the markets in between, and then rotating in between those will be our mindset meets mechanics. All right, thanks everyone for your attendance today. I hope you all got something out of it, and I look forward to catching up with you in the next one. Bye for now.